let's go to the things that I've learned, the 4 things I've learned in 50 years of trading. That's where I live, incidentally. That is St. Croix. It is a little nicer than Montana because it doesn't snow there. And here are our next chart. Here are the 4 things. A, markets can be forecast. Now that is so incredibly critical because if markets can't be forecast, why are you in this room? Now, there's a whole body of evidence out there that says markets are not predictable. The efficient walk theory, if you will. The markets are so efficient nobody can make money. So it's absolutely critical you understand they can be forecasted. Now, not necessarily good all the time, but there are parts of the markets that are predictable, thus we can trade the market. Because if that is an untrue assumption, you better grab your books and run out of this room because it's all random. Now, if you read a lot of collegiate texts, you'll find that they say that the market is so efficient that it's randomness. The reality, though, is there have been consistent winners in this business for years after years after years. Guys like Steve Cohen, who left Wharton School of Finance and suddenly is now worth like, I don't know, $40, $50 billion, just tried to buy the Los Angeles Dodgers. He's made a return for his clients of 30% per year for the last 25 years after deducting 50% management fee. So that's one example. Or John Henry, who got so wealthy that he bought a baseball team. Anybody from Boston? Have you heard of the Boston Red Sox? Well, that's owned by John Henry, a commodity trader. And you see this throughout the world, that the commodity traders have made a lot of money. I think I'm the only one here that can stand in front of you and say, I've made millions of dollars trading the markets. Not 1 year, not 2 years, but repeatedly. Actually trading, have made millions of dollars. So it is possible to make a lot of money. In other words, markets can be forecasted at least a little bit. There are patterns in the market. There's trend in the market that we can take advantage of. That this whole idea of the markets being totally unpredictable is written about primarily by college professors, and we fund their scholarships with the profits we make trading. So I always keep that in mind, that there's fortunes have been made in the marketplace, therefore they are predictable, and not just by guys who flipped a coin and got lucky, but people who have done it consistently over a long time period, 50 years in my case, and some of the money managers even longer than that. So they are predictable. This is such a key one to me. Fundamentals matter. What a novel concept. Most people look at charts and think that charts move the markets. They don't. Charts represent what the market has done. But it's really tough to say that they're predictable, that the fact the market did this or that is going to predict what the market's going to do tomorrow. A chart is a repetition of what has taken place in the market. That's all it is. It's like the smoke coming off of a steamship. It doesn't say, it says the direction the steamship's been going in, right? But you don't know for sure from reading the smoke. Maybe the pilot is going to go whoop and turn the ship right there. So you can look at the smoke, you can learn a little bit from the smoke, but wouldn't it be better if you're able to talk to the pilot of the ship? Say, hey, dude, what are you going to do with that ship? You going to take a turn here? And he said, oh, yeah, okay. Well, that's why fundamentals matter, because ultimately fundamentals drive markets. My theory of the markets is basically markets move from here to here for a fundamental reason. But they go like this, have you noticed that along the way? Because of the emotions and the news of the marketplace. The emotions and the news of the marketplace cause this action as prices move from here to here, driven on fundamental conditions. Tommy Lasorda, speaking of baseball, the former manager of the Los Angeles Dodgers, had a great line. He would always tell his athletes, he'd have to cut some athletes and then they'd come back later on and have great careers. And his line was that God may delay, but God does not deny. I love that line, especially in terms of fundamental values. Fundamentals may be delayed for a little bit, but they're not going to be denied. If there's a real shortage of corn, it may bounce around for a little bit, but if there's a real shortage, it's going to go higher. I mean, that's absolutely going to happen. So unlike a lot of people that just look at charts, I really look at conditions in the marketplace to see, are we out of the market? Are we in the market? We have large supply, small supply, all that stuff. I'm going to talk a little bit more about that. The other one is, the key is money management. Clearly, this is so critical. I almost put it number one. But I thought you'd fall asleep if I put it number one, wouldn't listen to me. Because most people hear money management and their eyes just gloss over. So let me wake you up a little bit. In fact, the last time I spoke for TradeStation in Las Vegas, and it was a group, we just had lunch kind of like this, but round tables. And I said, what I'm going to tell you in this speech is how I made a little over $1 million trading last year, starting with about $100,000 in my account. I'm going to give you the exact formula that I used to do it. And I looked, and the guy next to me is sleeping already. Money management, man, it puts people asleep. But it's just the ultimate critical thing. When I took the $10,000 in the Robbins World Cup Trading Championship and ran it to $1.1 million in a year, it was because I was hot in the market, clearly, but primarily because I revolutionized the trading money management approach called Kelly ratio. And I really was overbetting too large all the time. I didn't know it because I was, what do I know about this stuff? I'm not a mathematician. I started as an art major in college. So the math is a real hard part for me to understand. But I was able to do that because of good trading and the increase in my account through money management. What some people don't realize is the account balance went from $10,000 to $2.2 million at the high. And then we had the crash of '87, and it came down to $750,000. So we call that an equity dip. My wife calls that was the year that I lost $1 million. But I traded it back from the $750 to $1.1 million. And thanks to money management and being relatively hot, in a hot hand. So that's the largest gain in any of these trading championships ever. It was because of the aggressive money management style that I used. 10 years later, I was homeschooling my daughter, Michelle, who many of you have seen in somebody just mentioned My Week with Marilyn. That's my daughter. If you happen to see the Marilyn Monroe movie, that's Michelle. And I homeschooled Michelle because she was doing Dawson's Creek at the time, and it's really hard to go to school and be on set. So I know what my kid's got to learn, right? She's going to be an actress. She needs to learn percentages. She doesn't need to learn division. She needs to learn addition because you want that up how much money she made, but they all take percentages of actresses' money. So I taught her percentages. Okay, we're through with math. Now in case you blow out acting, how about learning to trade? So I taught her to trade a little bit. And she started a $10,000 account in the Robbins World Cup Trading Championship and took it to $110,000 in 12 months. As a 16-year-old kid. Oh man, did the other people in the contest get upset. The kid beat them. So they wrote letters to Robbins, brokerage firm, and said, hey, a kid can't trade because a kid can't enter into a contract. That was really Larry's trades back there. And then we pointed out to them we'd actually emancipated Michelle so she could work as an adult. We went to court and got an emancipation process so she could contract with MGM and with, who's the other big, Paramount. And so actually she could trade. And I taught her to trade, and then she just followed a system, but with a money management formula, which I'm going to talk about a little bit later. So she has the second largest gain in the history of the trading championship because she used a pretty aggressive money management strategy, and fortunately we got lucky, or she got lucky, the system worked for a while. So the exponential gain in your accounts is going to come from money management. And then this is the last one that probably you already know is trend is gravity. I just cannot overemphasize the importance of trend. Once the markets enter a trend, it's just like gravity. I don't know if any of you ever jumped out a window to see if you could defeat the law of gravity. I've tried that. As a kid, my brother said, you know what, there's this building over there, and if you run up that with an umbrella, you'll float down to the ground. I had just a little button. I didn't know anything about that, so I grabbed an umbrella, ran up there, and boom, came right down to the ground. And then my brother said, you know what, I've been thinking about this, Larry. Bob said, the problem is there's not enough air in the umbrella. So we'll get a sheet. We'll get one of Mom's sheets, and all the air will billow up in the sheets. Okay. And again, I ran right up that thing and jumped off right down to the ground again. That's when I stopped listening to my brother. But, I had to find out. And what I found out is you better check these things in advance. But that was my lesson, the law of gravity, and I've seen it since, that if a market's in a big uptrend, I'm going to show you two ways of trading with gravity. Trends persist. I think it wasn't Newton that said an object once set in motion tends to what? Stay in motion, right? Well, that's true of the marketplace as well. But all you people, not only are you greedier than other people, are you more risk-taking than the other people? Another thing I've noticed about most all of you, you're more intelligent than the other people. And you know what intelligent people like to do? Argue. We love to argue. So if the market's going up, what are we going to do? Argue with the market. Oh, it's going to go down. And I'm smart enough to know it's going to go down because I'm one smart dude. Well, unfortunately, the market has taught me that I'm not very intelligent. I seem to learn that lesson almost on a daily basis. So just acknowledge what's there. One of the best things that I've learned about understanding the markets is that in our life, we're bombarded with messages all the time. You saw this today. You see signs out there. I can see a chart out there. If you drive outside the hotel, you're going to see billboards, television commercials today, radio commercials, newspapers, magazines. We are bombarded with messages, right? Has anyone felt that way? Every day. Somebody added up, it's like 1.5 million messages every day we're bombarded with. So what we've done mentally, our mind goes, it's learned to block things. I don't see it. You'll drive home today or get on an airplane like I will in the morning, and there's things that will be in our frame of reference and we won't actually even notice them because we just block them. If you don't block them, you're just going to go crazy. And part of blocking is to block and then fast forward and go, oh, I know the answer, and go right by it. So we've learned to do that, which means when you look at a chart, your mind works the same way. It blocks what's there because you know the answer already. And it fast forwards to what you think the answer is. We do it in our relationships too. Your wife says, I want to talk to you about da-da-da, and you already think you know what she's saying. And you're probably wrong, especially if you're a guy. Your wife will point that out to you repeatedly. So it's good to just sit back. I just will walk back like 4 or 5 feet from a chart and just look at it from my screen and go, what's really going on there? Because Larry has an idea of what's going on. But you know what? If I just sit back and go, especially if I have like a glass of wine late in the evening, a lot of insight there, you relax a little bit and go, don't have 2 glasses though. I did that. It didn't work. Just relax with it and see what's there because we have these preoccupied ideas. We know what's going to happen and we've blocked or fast forwarded. So when you're looking at your charts and your indicators, don't do that. Just relax. Just don't be so uptight about this. Let it tell you. You can't tell the markets. Okay, well, let's get a little bit more specific here. Harry, could you pour me some glass? I'm being helped today by Harry Martinez, so some of you know. Thank you, Harry. So, chart 2. Well, here's an example, excuse me, that markets can be forecast. This is my forecast for 2011. How many people got my 2011 forecast? Some of you did, right? Good. So this is not something I made up for today. This is what we actually said would happen last year and what we've actually said would happen this year. Now, I don't know how well the forecast was going to be. So far, it's been pretty good. Last year, we were able to nail this big decline. We didn't get this first part of the rally this year, but we certainly got this decline we've been in now. And it's suggesting a low in July and a better buying opportunity in September. So we can actually, it is possible to forecast things. And there's some evidence of that it is forecastable. Thanks to computers, thanks to guys like Bill Cruz putting things together, we can synthesize data. Excuse me. This is created by looking at cycles in the marketplace, seasonal tendencies in the marketplace, and in pattern. So, as an example, this is 2011 from basically here to here, and I can go back and find all other years that move similar to 2011. And then see what they did the following year, and add all the following years together to get what happens once we've seen this type of a pattern in the marketplace. This is kind of the pattern that's usually followed. But then I'm going to add seasonal patterns and cycles in it. So that's the general idea of how these patterns are constructed by using data from the past. And they've been pretty darn accurate, which means I have a good idea of what's going to happen already in 2013 and 14 and 15. How many of you did not see either of my presentations prior to this? How many did not see? Okay, then we'll do a couple little fun things here in a moment. Harry, let's go to our next chart. Here's a 2-year pattern in the Dow Jones Industrial Average is really operative in the marketplace. I want to call it to your attention. What's important is not the highs and lows that you see here, but these little cliffs and bottoms. Look at this little pull down in this 2-year pattern. Look where it occurred. Look where it occurred. Look where it occurred. April this year. What happened in April this year? Stocks topped out. Now, what's important now is stocks have already come to decline. This was actually out of my forecast in 2012. I did this last January. In 2011, the end before 2011 was even over. But look what we're getting into now. We're getting into some buy points in the 2-year cycle coming in again about September, and just before the election, somewhere in late October, mid-October, we're going to enter an up phase of the marketplace like we've seen in here, and we're going to have cyclical bullishness in the market. So these things are forecastable to at least some extent. And there's a good technique to use. And Harry, let's go look at our next chart. This is a really neat one. This is one that we also had in the 2012 forecast, a cycle kick up in the bonds. See how this little cycle kicks up like that? See that? And so I said, look, guys, we got a buy signal coming about April 30th in the bond market, about July 30th, and about October 26th, October 30th, somewhere in there. Oh, also, these don't predict exactly to the day. Sometimes they do because they just get lucky. But it's a general, in that time zone, I'm going to look for a rally. I don't expect any of my work is so good that it's going to call it right on the button. But real close to the high or the low, these things should occur. So that was the forecast at the first of the year. And Harry, if you would go to the next chart, this is what actually happened. There's where this little kick-up forecast should take place. Wow, look at that. In other words, we knew a year or so in advance that bonds should have an explosive move at this time period. And indeed, they certainly did. And you might want to write this down because at the end of July, we have another kick-up in the bond market. So as a short-term trader, if I get buy signals in the end of July, I'm going to take them. And I certainly don't want to be short. If the market comes down in here, that's an opportunity to cover my shorts, let that rally run up, maybe sell the rally, but I know we have a real bullish explosion of energy in the market coming in the end of July. In fact, Jerry, why don't you back that chart up because there's a second one they can look at as well. Now you've seen how this actually played out in real time. You might want to note that one at the end of October. And again, I don't know, it'll be October 26th or the 27th, but somewhere in that last week of October, I'd expect the bond market to take a kick up and have a rally in there. No questions? I bored everybody? Okay. So markets are predictable. That's a seasonal influence. And seasonals can influence prices. As those who were with me yesterday and the day before know, you need to look at seasonals in relationship to price to get an idea of what's going on or what should take place in the future. And our next chart then, Harry. This is the bond cycle updated. You saw that. That was a buy point. We'll expect a rally. And let's go to our next chart now. So fundamentals matter. Well, what do I mean by fundamentals? Most people, when I come to events like this, are so technically oriented that they know more about stochastics and moving averages and Hall moving averages and I don't know what's the popular indicators right now. MACD. What else that people use a lot of? Pardon? Bollinger Bands. That's a big one. Yeah. You know what? They all say the same thing. Were you with us yesterday? I don't recall. Bollinger Bands look exactly like MACD if you put them on the same time frame. Everything looks the same because you know what? We're all massaging the data the same. As you guys saw yesterday when we looked at percent R, looks just like Bollinger Bands, which just looks like the commodity channel index, which just looks like Bollinger Band. It's all the same thing. So it's more important you learn the technical indicators because they're just a reflection of massaging price. But supply and demand really matters. Are we having a large production of soybeans this year or a small production? What's a crop in Brazil? What's a crop in America? What's a crop in China? Those things really matter. So while most people study Bollinger Bands or my percent R, or whatever the technical indicator is, you know, you're looking at the tail of the animal. You're not looking at the heartbeat of the animal. The heartbeat is the supply and demand in the marketplace. And you really have got to start looking at that. in terms of the stock market, you might want to Google something called the Fed model. The Fed model is an interesting model of stock prices that the Federal Reserve has. I first read about it in their beige books, I don't know, 25 years ago. And now somebody put it in an actual indicator. And it shows when the Federal Reserve thinks stock prices are high or low. Do you think that would be helpful to you? Because the Federal Reserve thinks stock prices are high, they're going to goose the economy. If they think stock prices are too high, they're too buoyant, they're going to depress things. Well, guess what? In 2008, the Fed model was way overvalued in stock prices, and the Fed stepped in. So I don't think it's just the fact that we had the real estate implosion, but the Fed was definitely acting, and you read their notes, and they said they were going to get tight. So you probably will learn more by reading notes from the Federal Reserve than by reading any of my books or anybody else's books about what's going on right now. So fundamentals matter. In the commodity markets, this is the key one. It's called premiums. I'm curious, how many people don't know about a contango in the market, don't know about contangos? See, I always see that. Maybe 75% of the people don't know about contangos or premiums. Critical to understanding commodities because it is fundamental in nature and it's right in your newspaper every day, just right there for you to look at. What I mean by that is typically in the commodity market, the nearby contract of, say, soybeans will sell for more than the distant, or will sell for less than the distant contract. Because the guy who has soybeans to deliver or corn to deliver in December has interest, storage costs, insurance on it, and he may not produce the crop, so he has risk. So traditionally, prices in the future are more than nearby prices. That's the way prices usually are in the commodity markets. On rare occasion, we have an inversion where the nearby is at a premium, that's the word, to the distant contracts. It's rare, it does not happen all the time, but it's very significant. If the nearbys are at a higher price than the distant contracts, somebody wants the commodity price desperately. It's not you, it's not you, it's not her. It's the commercials, the people that buy the commodity because they need it for their business. The commercials, we'll talk about those guys in a moment. But the only possible reason we can get an inversion and go to a premium, somebody wants the nearby commodity so badly they're willing to pay more for it now than waiting a month to buy it. So that means it is in tight demand. People want it. That's a supply-demand equation then, isn't it? Now we see that it is in tight demand by the big guys, the commercials, and we know we have a potential for a bull market. You might want to look at the grains right now. Corn is in a premium. I think soybeans are in a premium. There's some premiums that are developed on the board. Sugar just went into a premium. That means that the bias of these markets fundamentally is to rally. That is significant. When we're not in a premium market, it means nothing. That's just business as usual. Markets tend to go like that. They may go up, may go down. But a non-premium market doesn't tell us anything. But a premium market is an abnormal situation that we don't see. And that's a really strong message. So I would prefer on your charts you'd be looking at premium structure in the marketplace versus looking at another oscillator, another indicator, another moving average. Those things are not fundamental or germane to what's really going to take place in the marketplace. So premiums are significant fundamental information. Also commercial buying. We have a report from the government that comes out every Thursday that shows the amount of buying you people are doing in the marketplace. All of the stuff you guys are trading, that's reported by the government. They have one of those little drones in the sky now. They're watching your trades. Not yet. We'll get there probably. And they also then show the large traders, people that trade in large quantities like myself and or people that run funds, commodity funds, primarily commodity funds now. And then the third group is commercials, the people that actually produce or use the commodity. Well, clearly, if I am in the gold business, I'm a miner or I'm a jeweler, I know a lot more about my market than you know about gold. Because it's my business, I've got to know about it. So the commercials have a really brilliant record of being right in the marketplace. You have to understand how they operate. You look at a chart, you might not quite understand it initially, that the commercials like to buy weakness on balance. Think about it. If you're, you make candy bars, and the price of sugar is coming down, are you going to buy more sugar or less sugar as the price comes down? You buy more because your cost of your candy bar is less, isn't it? So the commercial will buy weakness. The big point I want to make about commercials, they don't speculate in the market. They don't try to make money in the market. That's what we do. They want to buy sugar to take delivery because if it goes lower and lower, that's great. Their cost of the product is less. So they will buy because they're going to take delivery for it, and it's better to their business. So they will tend to buy weakness, and you need to understand they're not speculating. They're not trying to buy here and sell there. They don't make money in the futures. They make money by taking the product, frothing it up, putting some sugar on it, putting some corn in it, and suddenly a bushel of wheat is now worth like $26,000 as a box of cornflakes or corn pops with sugar on them or fructose on them. So you need to understand the commercials, and their buying levels in the marketplace are really, really significant to help us understand when a market's going to rally or decline. So that to me is fundamental information. Commercials, what they're doing. Another one is advisory sentiment. I monitor each week about 100 websites, newsletters, brokerage firms to see if they're bullish or bearish. It's really interesting. When 80% of the advisors get bullish on the market, it's going to go down. It's just like, this is almost clockwork. When about 10, 15% of them are bullish, in other words, 85% of them are bearish. They're sending out emails and newsletters, sell the stock's going to rally. Or the commodity's going to rally. Somewhere in the near future, you're going to have an up move in the marketplace. Jim Sibbett first did this work back in the 1960s at, I forget the name of his advisory, so Market Vein. And I've added to have a larger database of about 100 people. First wrote about it in a Bloomberg book in 1999. We've been doing the exact same work, carrying it forward now for 12 years. And some of you have my advisory sentiment index in your computers. Anybody have it here? Some of you don't. No one here is a Genesis with it. Well, it's a really good indicator to tell us when too many people have been buying. And what's nice about it is typically you'll talk to somebody about the market and they'll say, oh, yeah, everybody's been buying. Well, how do you know that? Because you talk to your neighbor and your banker, maybe. But you really don't know. It's just like a general feel for it. Well, I really do know because of the surveys, the measurements that we've done. I actually do know what percentage have been buying or selling. So I have, it might be wrong, but I have an absolute value that has a good record of what's really gone on in the marketplace. Also, valuation. And this is an interesting point. There are two types of commodities. I hope you never forget this. There are two types of commodities, and you have to treat them differently. There are natural resource commodities. Those are things that we get from nature, from God: corn, wheat, soybeans, lumber, eggs, cattle. Those are natural resources. And then we have commodities. They call them commodities or futures. They're not really, they're futures, I guess, more than a commodity. The Swiss franc. Have you ever picked a Swiss franc off a tree? Have you ever dug up a treasury bond or a contract of E-minis? I like to bury a couple of contract of E-minis occasionally. But those are man-made commodities, if you will. And they need to be treated differently than the natural resource commodities. We don't get the premiums in the man-made commodities like we get premiums in the natural resource commodities, as an example. And the players are a little different in those two markets. The players in the man-made commodities, the commercials in those commodities, are banks and governments and large corporations. If I'm doing business with Japan or China, Brazil, and I've sold them something, I need to hedge my dollar position, if they're buying in dollars or yuan, in the marketplace. So those are the big commercials on those markets. They're there, but they're not the producers as we think of a guy who's raising cattle. You really need to understand those two differences. Now, what I found for a valuation model is all of the natural resource commodities can be valued against gold. When I was just a kid, my grandfather told me that you can always buy a man's suit for 1 ounce of gold. And at that time, gold was like $20 an ounce, and that's about what a suit cost. And then Richard Nixon took us off the gold standard, and that's what a suit cost. And now you can get a nice suit for about 1 ounce of gold. Or you can get two suits if you go to Men's Warehouse. They pay me to say that? No, they don't. How many people buy gold? How many people buy gold? Here's a way to buy gold cheap. This is the greatest way I found to buy gold cheap. I haven't done it for a couple of years, but whenever I have a grandchild born, I always buy a 1-ounce gold coin for them. And you know, I'm a skinflint like you guys. I like to buy low. And so I'm looking, how can I get this gold coin cheap? Then I went to all the dealers, all the same price. I got an idea. I went on eBay. And there's guys who just, you know, there's no buyers for a gold coin. At that particular day, there was nobody interested in buying gold coin. So I bid below the market, and I got my first gold coin. Below spot by quite a bit. I go, oh, this is cool. So next grandchild comes along. We went right back to eBay. Now, the problem is you can't buy massive amounts of gold. But if you want to just nickel dime or buy something for a grandchild, you can do it. I always buy one gold coin for each grandchild and write a little note. You know, it says, I may not even be alive when you turn 21, but I want you to compare the price of gold versus what things cost back then. Here's what things cost now. And watch what the price of gold is going to do. And it's not about the price of gold. It's about the government. The government is what the problem is. And gold doesn't go up just because it's so rare. Gold goes up because of the mess of a financial system we have. I hope you learned a lesson in economics. You know, good luck to you, young man or young lady. But that's a kind of a cool way to buy gold. Just go to eBay and you'll find some guy and he's got a gold coin there. And you know, gold isn't, well, especially when it's not real active. You can pick up gold below a dealer's price and no commission on it. Okay, so I noticed that prices relate to gold. As an example, gold is going straight up and wheat is going straight up. There's like a band. They're that far apart, right? But if wheat starts to go up more, that band is narrowed, and now wheat is relatively high priced to gold, and it's going to come down. By the same token, they may both be going along like that, and suddenly wheat comes like this, well, it's way undervalued to gold, and it will come up. And virtually all of these natural resource commodities relate to gold. So you can do, and I've got that in my courses and stuff, but it's a great general idea of when a market is overvalued or undervalued. Not overbought, oversold. That's a technical indicator. The cool thing about undervalued, a market may go, like the dollar index went down for, 3 years. It never really got into a traditional signal from an overbought, oversold indicator. Sometimes you see a market running straight up and it goes undervalued for just a couple of weeks and it just explodes to the upside. No technical indicator would have picked that up. It's a relationship of these futures to gold that really seems to be the value, the driving measure is value. Comes from the gold market. And finally, money supply and interest rates really drive things. You don't look like an audience that would know much who Hank Williams Jr. is. Anybody know who Hank Williams Jr. is? Oh, wow, you guys do. That's good. My kind of music, you know. He's a little liberal for me, but he's not bad. Hank Williams Jr. has this song called Country Boy Can Survive. And you don't have to go to college to learn economics. It's all in the song. And the line in the song is, interest is up, stock market's down. You only get mugged when you go downtown. And that's all you need to know. If interest is up, stock market's down, and you're going to have crime in the streets. There's just one line from that song. He's got another line I like too. There's a guy on a TV in a coat and tie and vest, wants you to send your money to the Lord, but gives you his address. Well, I like that one too. So fundamentals matter. I want to look at fundamentals. There's an idea of fundamentals. And our next slide, Harry. Here's an example. This is the 2-year the yield spread, and it's the yield curve pushed 2 years into the future. That's this gray, yellowish line over here. Notice it bottomed here, and then stocks bottomed, but we knew this bottom 2 years in advance. In other words, interest rates lead the economy. Here's the stock market tops out. Well, yeah, the yield had topped out, hadn't it? The yield curve bottoms here, suggesting a rally in stock price. This was known 2 years in advance. Where are we now? We're right up here. Yield curve is predicting lower prices in stocks. When it turns up again, that's going to be the big buy point, which will take place, as those who have been with me the last couple of days know, 2014, October 3rd, 9:12 in the morning, somewhere. It might be 9:13, but close to that time period. This is most likely, I think, is going to turn up. We're going to have a hellacious bull market starting 2014, 15, 16, into 17. But I want to watch a yield curve for my long-term stock market major bottoms. where you just push all the chips across the table and buy and close your eyes and go to bed and hope it rallies. So again, fundamentals matter. That whole thing in 2008, well, look what happened. Yield curve tops out, stocks come down. So interest rates and money supply are critical things that we need to look at as traders, as investors, not just a bunch of wiggle waggles on charts. Question?
You said the yield curve is 2 years ago.
Predictive forecast 2 years in advance. So it gives a 2-year lead time on when we'll top and bottom in the market. How cool is that? You're not going to get an oscillator that's going to tell you 2 years in advance what the stock market's going to do. That's why I say, by and large, technical analysis sucks. Because it's just about right now. And it's really difficult to read. It really is not fundamental to what goes on in the marketplace. Please.
So yield curve's high, yield curve is high, stock market will go.
I would say I'm not interested if it's high or low. I'm interested when the yield curve rolls over or turns up. It could turn up from this level. It can turn up from any level. It's the turn ups in it and the turn downs in it are the important thing. You can Google it. You'll find several services that will show you a little chart for you, the yield curve. And it's something I always keep in my little, those things you got on your computer. You can go right to it. You put it on the side and click on it. I don't know what those call those things, but it's in your, like an address book or something. So I really want to know what the yield curve is doing. It's important. Question?
This would be a snapshot of the yield curve because it's changing every day.
Well, this is, yet actually they publish this every single day. I'm 2 years in advance, right? So I don't care what it's doing right now, do I?
But in a month, in 2 years' time, it's different.
It'll be the same. This low is going to be the same. That high is going to be the same. Notice where this high is, right, when stocks started to decline this year. And those who have my 2012 forecast know, we said, April, yield curve rolls over. April, stocks rolled over. So it's a way in advance indicator. Again, it's not right to the day. It's like a general, got to be careful, or I want to be a big buyer of stocks for a significant rally. Okay, let's look at our next chart. Nothing is more important than how one wagers. Nothing. I've blown out accounts. Anybody that's traded commodities that doesn't understand money management has blown out accounts in their life at some point. We've all done that. Paul Tudor Jones did it. Steve Cohen did it. Everybody's blown up because we didn't understand money management in the old days. And now we have a lot better understanding of it. And the understanding is that you don't want to risk very much. When I was a young guy, I bet everything on every trade. I didn't have any idea of money. Nobody had written about money management until Ralph Vince came along. You might want to read Ralph Vince's book. Ralph, V-I-N-C-E, has written the best money management books. And is Sonny Harris here? Sonny's done some good money management stuff as well. She's a big trade station person. You might want to contact Sonny as well. Basically, the whole idea is as you make more money, you're going to increase the number of contracts you have. What I do in my own personal trading, I risk 2% of my trading account on every trade. So on $1 million trading account, I'm going to be risking $20,000 on a trade. If I stop that, I've lost $20,000. I can handle that loss financially and emotionally. So if my stop is, let's say, $1,000 away, then I know I'm going to divide 1,000 into $20,000, and I'll have 20 contracts on this trade. When the account balance gets to, say, $2 million, 2% of $2 million is $40,000. Divided by $1,000, I'm now trading 40 contracts on the trade. And as I go up, I increase my contracts. As I come down, I decrease my contracts. And I use 2%. You want to be really aggressive, you can use a higher number, but I'm 70 years old. I don't need to trade. I don't need this high risk in my life anymore. I'm real happy with 2%. Doesn't sound like you'd make very much money with 2% risk, though, does it? But in Australia, interesting chapter in my life, I got out of prison. I'll tell you about that briefly, and had a $100,000 account. And a year later, the $100,000 account was $1 million. It was $1.some million. I was arrested in Australia for income tax evasion in the United States. And we fought extradition in Australia. It was about a 3-year battle that we lived in Australia. It was really interesting. A lot of great stories. One of the ones I was in jail, and my cellmate's a bank robber. I'd never met a bank robber before. I said, a bank robber? Oh, you must be rich. Well, we made a lot of money. I said, how much is it? We got, like $10, $11 million. I said, wow. I said, what happened to the money? He said, a heroin addict I was. You know, we were doing like $20,000 a day in heroin and cocaine and stuff. Oh, wow. So I said, well, did you ever get, I said, tell me about bank robbing. He says, well, he says, there's a system for it. I said, hey, I got a system too. Let's talk. I said, tell me about your system. He said, oh, well, you need 3 guys. You need a driver. You need a door guy to control the door and me. I'm the jumper. We call him a jumper. You run in, jump, you swear at everybody, jump over the counter, grab the money, and run out. I said, any other rules? Oh, yeah. He says, 3 minutes, you're out of there. Because the cop's response time is 3 minutes. Says, you're a day trader, son. Great rule. A time stop, right? So then I said to him, did you ever get stopped out? He looked at me like, what are you talking about? I said, did you ever get caught? Oh, yeah, I got caught one time. What happened? He said, I got shot, picked up his shirt, or actually on this side, you can see where the bullet went in. I said, whoa, they caught you? He says, yeah, got caught, and we went to trial, and at trial they couldn't prove it was me because they're so dumb on the banks, because they have the cameras up there coming down on you. He said, that's another thing, I forgot to tell you the other rule about robbing banks, you wear a baseball hat, because a baseball hat shields your face, right? So the camera doesn't get a good picture of you. This might be the only thing you'll learn here in Dallas. The next time you walk in a bank, and even if the line is short and some dude's wearing a baseball hat, I suggest you walk out of the bank. You don't want to stay, doesn't matter if it's a short line or not. And he said, then in prison, the food isn't very good in prison. He put on so much weight, because he went from being a drug addict to eating starch every day, they couldn't really identify him. So he got off. But he was a bank robber. So I said to him, I said, wow, that's really interesting. He said, do you still rob banks? I said, oh, no. He said, when I was in prison, I made a deal with God that if I got out of this, I would never, ever rob a bank ever again. I'll rob a jewelry store or a liquor store, but I will not. This is a true story. This is amazing. Well, eventually I came back. We went to trial in the United States in San Diego, and the third day of trial, the government dropped all the charges. They dropped all the criminal charges and said, hey, you know, let's work a little deal out. You pay $25,000, $50,000 and let's part company. We both had too much money into it after they saw the evidence of my trial. I said, okay, fine. So that was one chapter closed in my life. But I learned a lot by seeing these guys. It's like really bizarre to be in that culture for a while. I learned the Australian culture of their legal system. So money management is important. It's how big of a bet you wager. If you bet big, you'll lose big. Charlie DeFrancesco is the world's largest bond trader. He's dead now, and he was the largest bond trader in the pits ever, by far. And Charlie loved to gamble. I'd go to Las Vegas with Charlie D, as everyone affectionately called him, and he's gambling one night. Charlie's lost like $400,000. I'm just part of his entourage. He's like, wow. And the pit boss came over and said, you know, Charlie D, what I like about you, you know, to win big, you got to bet big. I go, oh, wait a minute. If the casino is giving me money management advice, I'm going to do exactly the opposite, right? That was like the pivotal moment in my life. That was the epiphany of money management, when this guy is saying, you know, to win big, you got to bet big. Because if you bet big, what's going to happen if you lose? You lose big, won't you? So never, ever, ever, ever bet big. Just keep that as a simple money management strategy. I could codify that by saying for every $10,000 you have one contract on in one market, and that's it. And that's really risky. I'd even probably have less. So let's give them the next rule on money management. There it is. Bottom line of money management is always. Can you see that? I hope not. What does it say there? Bet small. Okay? Right there. Forget about that. Right there. That's it. Because if you bet small, you can't win big unless you're an absolute idiot and let the market go way, 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 way against you. Okay, our next slide, Harry. Here, Einstein was the great commodity trader. A lot of people aren't aware of that. He left us with this formula. E equals MC squared is the ultimate money management formula. Most people think it's got something to do with energy and stuff, right? It's all about trading. Let's go to the next slide. No, go back. I'm sorry, come forward, Harry, one more. To the Einstein slide. E is your emotions. how emotional you get are based on the amount of money you have squared by the number of contracts on the trade. So your emotions are not driven by the fact your mother didn't breastfeed you or your dad beat you up. That's got nothing to do with this stuff of trading. Your emotions are a function of the money in your account squared by the number of contracts you have. E equals MC squared. Your emotions are a function of the risk you're taking. Some people cannot afford to lose $1. They shouldn't trade. It's too much of an emotional charge for them. We were talking about this last night at dinner. It was a great dinner. How many of us went to dinner last night? Wasn't that fun? I really enjoyed that. It was a lot of fun. We were talking, and I said, my problem as a trader, I don't know many, but one of them is a $50,000 loss for me may be only like less than a 2% risk in the account that I'm trading. But it just bothers the hell out of me to lose $50,000 in a day. Because it's only 1%, but to me, $50,000 is a huge amount of money. So I get confused with the dollar amount versus the percent amount. I know intellectually it's just a percent. But, I did not come from wealth at all. And $50,000, I was, you could buy a couple of houses where I lived with that. 3 houses, 4 houses. And like, that's my stumbling block. That's my mental block is getting through. I mean, I get the $50,000 trade and I go, I start to just get rattled with it. So your mental block is different for everybody. I've done something where I'll say to somebody, hey, let's flip coins in a crowd like this. And we'll flip coins for a quarter. Heads you win, tails I lose, whatever. So we flip the coins and then they change it. So, but this isn't for 25 cents. We're going to bet for $43,000 on this flip of the coin. And the person's eyes blink, their shoulders hunch up like that. They go, oh my gosh, my wife's going to find out I bet $43,000. All these things, you just see them go through their mind. So the physical action of putting on a trade is not emotional. It's the mind looking at the money at risk on the trade that makes you emotional. So if you're getting over-emotional, you need to cut back the size of your bet in the marketplace. That's the real secret, E equals MC squared. Your emotions are too high. If you're too irrational as a trader, it's because your bet size is too big for your emotions. And you have to figure out where your emotional bet size is to be a good trader so you don't get warped by all these things. My son and I, my son's a psychiatrist at Johns Hopkins, have done a book that'll be out this fall where we interviewed 25 great traders, guys that have made billions of dollars trading, and guys like myself that have just been real successful for a long time. We found out a lot of things about them. One thing we found out, they don't get really emotional about stuff. Their emotions, they may come up a little bit like that, but they're primarily pretty flatlining their emotions. And the losing traders, as a personality profile, anything happens in life, they get really emotional. Somebody slams the door on their foot, the emotions go like this. The winning traders, the emotions do like that. They don't cycle and go all over the place. So you need to work on that as a trader, like not letting these things bother me, and one way of doing it is controlling the size of your bet. And you will not be as emotional. Emotionals are a short circuit to the logical process. We know logically we should go from here to here, but an emotional thing comes in and then logic goes out the window. So that's the importance of why we need to stop the emotions from rocketing back and forth because we can't follow a logical process then. Okay, our next chart. If you want a money management app, it's free. You can go to this web address, www.lwu, Larry Williams University, calc.com. And you can download a web app for your cell phone. You'll be able to put in your account balance, how much money you have, what market you're trading, what your risk factor is, how far away your stop is. It'll tell you how many contracts to have. And there's also more of an explanation of my money management on that on the app for you. So you can go there and you might enjoy adding that to your app. You're already putting it in, huh? Okay, so we've got that for you. Let you write that down. And our next slide. The law of market trends is the law of gravity in our world. I'm going over a little bit. Are we okay with this? Okay, we broke for the lunch thing. The law of market trends is the law of gravity in our world. Trend is just so incredibly critical. I still argue with trend. I'm realizing more and more that that's the fundamental mistake we make. We think we are smarter than the market. So, but I think of it as gravity. And when I started thinking of trend as gravity, I go, well, I know I can't defy gravity. Learned that as a kid. So that helps me understand the trend of the marketplace is as powerful as gravity is. And here we are, next slide. All profits are a function of time. This is really critical understanding. Every nickel or dime that's ever made in the market has been because of a function of time. No time, no profits. Trends are a function of time. The longer you can be in the market, do you think you catch a bigger trend if you buy today and get out in a year? You have more potential for trend trade, right? But if you buy today and get out 3 hours from now, can you catch much of a trend? You can't. So trend is a function of time. Time is our ally. Traditionally in the business world, in the world outside this room, time is your enemy. You put time in a contract, time we've got expired by this, so the contract is valid, invalid, all this stuff. We always see time as an enemy, but it's our ally in this business. We need time because time creates trend. No time, no trend. So I want to stay in a trade as long as I can. That's the day trader's dilemma. They're in and they've got 3 or 4 hours to make money and they're out. They cannot catch a big trend, but they can catch a big loss real easily. How many are you day traders? Whoa. Well, let me give you one important piece of advice. You day trade at home, most of you, I assume? Okay. I learned this one the hard way. I was trading copper, day trading in and out. I forget exactly what the trade was, but it was in copper. And my daughter came in, the actor's daughter, Michelle, with a bloody nose. And being a good father, of course, I took care of the bloody nose and da-da-da-da-da-da. And blood all over the place. She's screaming and crying, doesn't know what's going on. She's a young kid. Got it fixed. Go back to my copper trade. I forgot to put a stop in. $45,000 loss. I could have medevaced the kid to the hospital for less money, right? And people would always come in and intrude into my spaces trading because this is what they see. They see you looking at a screen. Does that look like work? No. So they walk, hey, how you doing? What's going on? Can we go out for dinner tonight? Can you pick up the kids? Can you do this? Can you do that? And it doesn't look like work. So people always intrude into your space as a short-term day trader, especially in your house. So you have to have a door there, either physical or intellectual door that says you cannot come into this room. You can say, I need to talk to you. Great. When I'm free, I'll talk to you, but not now. Because they come in because they just see you looking there, a little mouth, click, 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 click. And they don't get that you're really wrapped up in this. So you have to tell them, look, I don't want to have a $45,000 mistake like Larry did. So just separate your world from their world because they don't get what you're doing. I mean, they know that you're under pressure and it's trading and stuff, but it's just too easy for them to come walk in. Has anybody ever had that happen? People just come, yeah, see? So that's why you have to have this absolute barrier of some sort, like that Gardol shield they used to have in the old days. Remember the Gardol shield and the Colgate commercial things? Nothing could get through your teeth if you brush your teeth with Gardol. And it would protect everything. So you need that shield between you and these people because they're going to come on in to your space not realizing that that could be the moment you're in the copper trade. I would suggest you do that and also consider that there's easier lower hanging fruit in the market to capture moves that last 2, 3, 4, 5, 12 days because time is on your side then. You can catch a big move in 12 days. Also then, you can bet small and win big. Day traders primarily make as much money on a winning trade as they do on a losing trade. I don't want that. I want to be able to put up, maybe I'm going to lose $1,000 on this trade, but if I'm right on this trade, I'm going to pick up $4,000, $5,000, maybe $10,000 per contract on the trade. So I can bet small, lose small, and I have the potential of winning big. A day trader doesn't have that advantage for the most part. It's really tough to bet small and win big as a day trader because it's so volatile and your stops have to be so close and you're going to be stopped out a lot. So I think the better strategy because of trend is bet small, win big. I need more time on my side. Next chart. There are only two types of trading, trend following and anti-trend. You're going to be with the trend or you're going to be anti-trend. When the trend runs up, you want to maybe sell it short for a bounce back, but it's better if the trend is up to be anti-trend when it comes down, buy for the market to get back in trend because an object once set in motion tends to stay in motion. So if you're in a big uptrend and see a pullback, you want to be a buyer. Most people in a big uptrend want to sell the market. I don't know why. People love to sell strength. Sell, 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 sell. But in actuality, in a big uptrend, you want to buy anti-trend, let it come back, because most likely will come back to the trend. That's the better bet than selling it thinking that trend is going to stop because you sold it. So trend is just you're going to ride it as much as you can. Anti-trend, which is probably what most of us really do or try to do. When the trend is up and you got to pull back, and you're going to identify that with your indicator, whatever your technical. So always think about those are the basics of how you're going to be trading. Next slide. This is what I do. I have Larry TV that I do once a week. We've got some Larry TV people here, right? That I do little commentaries and forecasts. Hey, this market's going to rally. I just did Larry TV this morning. And Larry TV, we're going to have, we had a really great trading opportunity in the bond market. Typically, the bond market from 1980 forward, on the 8th trading day of the month has rallied 94, 95% of the time. That's massive, right? So I know we've got a short-term buy point coming on Wednesday, Thursday, this market. And you'll see that on Larry TV when you guys turn Larry TV on. Wednesday. Late Tuesday, Wednesday is the 8th and 9th trading days. We get good rallies in the bond market in June. So you learn information like that on Larry TV, and you see actual trades, and this market set up, look for buys, etc. And it's cheap at $25 a month. I do my annual forecast. I have some courses on there, and this is an advisory service where I give trades I'm actually taking myself. And you can go to ireallytrade.com, and there's more stuff there. Any questions? I run over time a little bit. I apologize for that, but if there's any questions you want to wrap up with, we'll do that. Yes, please. I'm sorry, I don't hear real well at my age. What is that? What? Where can we watch Larry TV? Larry TV, you got to pay for that at $25 a month. Can you imagine that? But there's a couple of free ones on ireallytrade.com. There's a lot of seasonal stuff. Everything, most all of it's free. So go to ireallytrade.com, you get seasonal charts, commemorative trader report, you get reports on trading systems. There's a lot of stuff there. I'm sorry? Just click on, go to iReallyTrade, and it'll direct you how to do it. We'll figure out how to take your money if you go to the website. The question is, you didn't hear it, he works during the day. So can you be alive and trade at night? It's very hard to day trade at night because the ranges are so small. But when I was in Australia, I just placed my trades and woke up the next morning because of the time difference. So that's actually how I trade now. I place my trades, I set my stops, and I walk away from it. So the answer, I think, yes. But you have to say, look, has anybody ever noticed it's helped if you watch the market? It doesn't. So you really don't have to be there. You feel you do, you don't have to be there. You're not going to mentally move the market. So yeah, you can do it. Please.
I have heard thoughts on that.
It's 1,000% wrong. Your stop is your stop, right? You put a stop in, it doesn't matter if it's 1 day or 1,000 days, that's where your stop is. Your stop isn't going to increase as long as you actually use stop losses. Maybe that's what they're talking about.
What they're saying is that there's more chance the market can go against you.
Absolutely wrong.
That's what they're
Absolutely wrong. It can only go against you to where your stop is, period. That's it. That's fixed, not a function of time. So if the market may go down a lot in time, that part of the statement is correct, but if you're stopped out, who cares? But you've got to catch the big moves, so time is your ally. Most people want us to trade our accounts too often. Yes?
I think what they meant was profit potential goes down as time.
Maybe in an option, because option you got to play beat the clock and beat the market. They're both tough games. But time is my ally, except in an option, because then they're expiring all the time. Maybe that's what they're talking about. But in a trend trade, no, I need time. I need time. Yes, please. What correlates to the real estate market is a question. I have no idea. I'm a commodity trader. I probably lumber prices and interest rates. But in terms of, I don't know. It's interest rates and lumber prices. Lumber prices. What forecasts lumber prices? I've done some work on it a few years ago. Lumber prices extended a year into the future forecast a housing index real well, or vice versa. I forget which. You drop me an email, I can tell you, but I don't remember off the top of my head. It's just, I'm a trader. A couple questions. Oh, no questions over here. I put these people to sleep. Questions here again. Yes. I'm sorry? A forecast for gold? Yes, I have a forecast for gold. Next question. Somebody wants to know what it is, right? I don't have it with me, but basically the forecast for gold has been this year is a big 4-year high in the gold market. You look at gold every 4 years, we have significant highs. So the big bull market in gold is dead in my world, but we have a great trading opportunity coming up about now in the gold market. And again, at the end of August, again, that's from memory, but that's when I'm looking for buys. Now we should have a nice little rally in the market, pull back, and sometime in late August, again, another rally in the market. It's in my forecast report, but I don't recall all of them. Yes, please, ma'am.
So what did you say about the market direction?
About market direction now?
Yeah. You said something on your TV program.
About the stock market now?
Yeah.
Well, I think we're in this rally phase in here. I expect we're going to rally up in here and come right back on down. And come into the ultimate buy point, I think, is going to be late September. I think the end of July we're going to have a rally in the market, come up, come back down into September low. That might be a higher point in September than the July low, but it doesn't matter in terms of the optimal buy point, because a market can come down. There's the actual low, but it does this, right, and then it takes off. So you want to sit through all this? No. This may happen. That's the July low, but the September explosion comes from over here. So to me, September represents a good time. Your question, please.
Does an election year really have that big of an influence on the market?
Yes, an election year does have a lot of influence on the market. I can't go to it easily, but you guys saw it yesterday that were with me and the day before. So what I did was look at what happens when Democrats in office are defeated and don't win the second term. The last time we did that was with Jimmy Carter. There's a lot of comparisons between Carter and Obama. And clearly the market continued, it tops in April, and it continued coming down until Carter lost, and then the market rallied. I think that's probably the track we're on, because I'm telling you, Obama's going to lose by a landslide from the polling data that I've looked at. So I think we're in the Carter scenario. But typically, around the election, which would be the most poignant to your comment, is typically around elections, before we vote, we get a little rally. Then we pull back after the election for maybe 7-8 trading days, and then we go, whoom, we really take off. It doesn't matter which dirty dog gets elected. People just have that relief. We finally come together again as a country. And shortly after the election, I expect a really strong rally in the market. That has the strongest part of the presidential pattern. Jeff Hirsch, I don't know if it's Jeff, I thought I saw Jeff a moment ago, has written about that as well in the Stock Traders Almanac. But my understanding from my work is rally before the election, pull back, and then boom, we really have a nice explosive rally after the election, like 5-6 days after the election. Well, fortunately, I did okay for a while trading. And then I got a little crazy trading, and then I would do this, make a lot of money, make $1 million, lose $500,000, make $1 million. It went like that. But yeah, I was able to come out pretty well. My very first trading, I lost money, which forced me to say what I read in the books was wrong. Because I always just followed a book. I won't even mention the author because I really like the guy. But I followed his book and did exactly what the book told me to do, and I lost money. I grew up, if it's in a book, it's true. I've since learned that's not necessarily so. I was a kid who was jumping off the shed with an umbrella, too. So it really put me to work to figure out how I think the markets move. And then once I got that, then trading went pretty well. Still, this is not a straight path to heaven. It goes up and down. But I would say most people, it probably takes 3-4 years before you get really good at this. It might be a better answer to your question. You should expect, which is why you want to bet small, or why you want to paper trade. You just don't get into this business and start making money hand over fist like people will tell you you're going to do. You're not going to do that. Most people have really unreal expectations. They think you're going to make a ton of money. You look at the great traders, if they can do 30-40% a year, they've knocked it way out of the park. That's a home run. And I talked to traders, they want to do 200% a year because I did it in the trading championship. That's an unreal expectation. You can do 60% a year. It's phenomenal. It's absolutely phenomenal. Yes, please.
How do you determine your stop loss?
How do I determine my stop loss? Well, I like to put my stops underneath recent short-term market points, if I'm long, underneath the market low. Daily, yeah. If I see a market has a real big explosion to the upside, close on its high, I want to put it right underneath that day's low. It shouldn't come back to that day's low, should it? So I'm looking at how the market's working to put my stops.
Do you day trade as well?
I don't. Well, I've day traded because I got stopped out the same day. But that's the only day trading I do now. And I haven't done very much day trading.
So if you got stopped out, do you get in that trading again?
No, I may get in the trade. If I get stopped out, I don't get angry. Because I'm looking for setup trade. I know market set up, like coffee set up to rally in here. So I'll take a shot at it. If I get stopped out, hey, that's cool. This is business. You know, in a retail business, they don't sell everything they buy. They're going to have to blow it out at a low price. So the same thing in my business as a trader. If I get stopped out, I go, oh, blankety blank coffee. I go, okay, I just got in too early. If the condition is still there, because I'm a conditional trader, not a technical trader, condition's still there, I'm still going to be working my buy orders. Well, I think I've way exceeded my time. I'd like to thank TradeStation for having me. I hope you learned a little bit today. Thank you very much. And good luck and good trading to you. I hope all goes well for you.